This is Capital Success by Chris Shepley, a series where we talk about all things day trading, the world of investing, and how to play the game of capital success. I hope you find value in this. These are the top 5 mistakes that every new crypto investor potentially makes when entering the market and how to avoid them. So we're going to talk about 5 key mistakes that most crypto investors that are relatively new to investing will make. And I'm going to go through, not in any particular order, but how to not succumb to these mistakes and what you can do to prevent them from occurring. So in no particular order, we're going to start off with the first mistake that a lot of inexperienced investors do when they're browsing social media and they fall for some of the sayings and some of the methods that some influencers may make. And that is using leverage to make trades when you're simply quite inexperienced in the trading market. So what I mean by that is a leverage trade is when you essentially are loaned a certain percentage of your capital to increase your purchase amount. So what that means is, let's say you have $1,000 and you're leveraged 100 to 1. That means that you're essentially given $100,000 to make the same trade. And what happens if you succeed is, depending on who you were lent by, you receive a pretty substantial portion of your profit. Let's say maybe 90%, 80%, 90%, 95%, whoever it might be. It's different depending on who you go with. And you'll receive that profit 100 times what you would have received with $1,000. But on the flip side of that, if you were incorrect in your position, in your trade, let's say you thought it was going to go up, it went down, you lose a certain amount until you cashed out, you close your position, but you've lost 100 times what you would have lost. And now if you've borrowed money from somebody, depending on, again, the setup and the agreement with the other person, you may have set a stop loss, so you only lose your $1,000 and then you have to give back the other remaining 99%. Or if you haven't done that and you've lost more than $1,000, you're now in a liability. You now owe whoever you borrowed money from the additional losses, whether that was $5,000, $10,000. Now, most of the time you set a stop loss, that doesn't happen, but there are individuals that neglect a stop loss. And what that does is it completely impacts your credit history, transaction history, and it puts a stain on your reputation in the market. So if you were to go buy a house or a car and looking for a loan, your history, similar to your credit history, shows that you have lost a lot of money or you owe a lot of money. It completely wipes you out outside of the crypto world. And now relaying that back to more the crypto aspect of, again, essentially you've lost $100,000, you have to pay that back. And it can set you back tremendously in confidence, of course, in monetary, but it sets you up for failure. And when you're an inexperienced trader, using any form of leverage, whether that's 100 times, whether it's 30 times, whether it's even 10 times, it's not the right option, because you can succumb to failure just as easily as profit. And regardless of how good you are at technical analysis, especially in the crypto space, which I always talk about, there's one thing with the crypto world that is completely different from the Forex world, from commodities, from every other world. It's technical analysis and emotional analysis are a 50-50 split. We see it over and over where all the technicals point the right direction, but the market falls, or vice versa. That is because emotional is half of the game when it comes to crypto. Leveraging, despite your technical analysis, could still go wrong, meaning you lose all that money. The second factor to consider when trading that a lot of traders make the mistake of falling for, and it's an easy mistake to make if you aren't experienced in the social media world, and that is falling for social media posts that promote airdrops or register your wallet here and you'll receive X or anything like that. So what that is, when you scroll through, let's say X or maybe Instagram, or I've seen it starting to go on LinkedIn, all these other places where there's individuals that post an airdrop. Maybe they're faking being a celebrity, or maybe they're just pretending that, oh my god, this is in a massive community, get involved. And they promote this airdrop where you have to go to the third-party website and connect your wallet and you'll automatically receive X amount of X token. Now, these are 99 or I would even say 99.999% of the time, completely fake. And what that means is when you connect your wallet, and this sort of leads into the next mistake that a lot of people investors get wrong, but referring to when you connect your wallet, they now have access not entirely to your wallet where they can buy and sell through your portfolio, through your portal, which I, again, refer to warm wallets as portals, but more refer to they now have access to your entire, I'll call it blockchain history. So they can view every transaction you've ever made, and it's relatively easy to connect the dots essentially and to identify a lot of personal information about yourself by doing that. Although crypto is very secure and very safe, hence why your public seed phrase, or public key rather, is a very large multi-digit sequence. It doesn't obviously have your name to it unless you've attached a domain address to it. When you connect to your wallet promoting an airdrop, you open yourself up for hacking and a risk of losing your entire portfolio. Now, it's something that thousands of investors succumb to probably every month, maybe even every week at these days. So the easiest thing to do is just completely avoid airdrops altogether. And essentially an airdrop is a pre-registered project, a pre-launch project that is saying, get in early and we'll give you a certain percentage of the total bag, the total supply in the market. And the benefit of those, typically, when the market officially opens to the public, you already hold a certain bag. You could sell, or you could make a substantially larger amount of profit than someone who got in when it opened publicly. Now, that is the pro of an airdrop that are genuine, that, let's say, celebrities run or certain businesses run, but they're just overwhelmed right now in the market with scams and fraud. So your best bet is just to completely avoid all forms of airdrop. Unless you 100%, I know for a fact that it is a genuine airdrop, just avoid them altogether. Now, the third mistake that led into that was actually not disconnecting your DEX wallet, so your decentralized wallet, from third-party apps. So if you went down the airdrop route and you had to connect your wallet to the website, if you didn't disconnect your wallet from that website straight away, as soon as you logged out of it, that website, you open yourself up to being hacked and to lose all your capital, and you open yourself up to extreme risk. It's no different even if you're using a genuine exchange. Let's say you've connected your warm wallet to Uniswap or PancakeSwap, or maybe there's a third-party business out there, a project that's building up, and they seem genuine, they're doing quite well, but they're still pretty small in comparison, and they have all the best intentions in mind, but they get hacked. Your wallet that was still signed in, associated with that, was also impacted. You potentially could lose your holdings because you kept your wallet connected. It's similar to logging in with your bank account. Go to a public library, log into your bank account, and then walk away from your computer without logging out. That's essentially what not disconnecting your DEX wallet is in the crypto world. So disconnecting your wallet is quite simply, it's an important step that you need to conduct when in the crypto world. There's not much to that. It's quite straightforward, quite simple. Always disconnect your wallets from third-party apps. There's no other explanation needed. If you don't do it, you open yourself up for hack, for risk, for losing your capital, so just disconnect it altogether. Even if it's a genuine website that you well and trust, still disconnect it. Just like your bank account in the real world, you trust your mate's computer, you trust your auntie, uncle, grandparents' computer because you're over for the weekend, still log out because you don't know who else is going to access that computer, or in the crypto space, you don't know who's going to access the behind-the-scene blockchain associated with your wallet, or you don't know if they're going to get hacked. You just don't know what's going to happen. So always disconnect your wallet. The fourth is slightly steps away from activity within your wallet, but rather it's not following a trading strategy altogether. So that refers to setting capital limits, diversification of projects, setting stop losses, as referred to before regarding leverage and other trading. If you don't follow a certain trading strategy, then you set yourself the risk, a slightly different risk rather, but a risk of not acquiring the greatest amount of profits that you could, or vice versa, waiting too long to cash out in a failing project. So everything in the world, when it comes to trading, investing, marketing, everything has some form of strategy and some purpose. When you enter the crypto world, crypto is slightly different, but let's say the investment world in general, typically you have a goal of making money. Crypto, in that case, is no different, but the crypto was based on emotional. A lot of emotional investors got into crypto because they saw the high gain potential. A lot of people get into Forex because they see the technicals and they see the longevity of it. But regardless, altogether, you need a trading strategy to know when to enter a trade, how long to hold the trade for. If it continues to go up, what percentage, what portions do you withdraw as profits as the trade goes, and when to essentially cut the trade. And if the trade is failing, knowing when to cut your losses and set the stop loss so you don't lose too much capital. It's about knowing how to do that regardless if you're in Forex or crypto. Now, a lot of people don't have a trading strategy when it comes to crypto. They get into it seeing these TikTokers, these social media influencers saying they've made millions doing meme coins or leveraging or whatever it may be. And they just go with the flow. They just trial and error. They do not set a trading strategy. But the true investors, the true successful investors set a trading strategy. And that trading strategy can be as simple as identifying when to cash out certain percentages. Let's say you bought Bitcoin at $10,000 and the graph shows it going up and up and up like it has. And Australian is currently about $160,000. If you held 100% of your bag since the 10,000 to 160, yes, you would have made 150,000, but along the way, it went from 10 to 30 to 7 to 60 to 30 to 75 to 35. See the up and downs, and as someone who couldn't predict the future at the time, you would think that you've just lost half your profit. Or if you bought in at the 35 and it went back down to 10, you just lost 25,000. That would have worried you, and you just didn't have a strategy in place to deal with those losses. And a lot of people didn't back then, because you got to think, you hear about all the success stories today, but a lot of people equally lost a lot of money. You hear about, it's not the same thing, but you hear about the person who bought 2 pizzas for about 10,000 or so Bitcoin. That would have been an absolute ton of money these days, but he didn't know the future of Bitcoin, and he just wanted to essentially cash out of Bitcoin. So you never know what's going to happen. So that's why you need to set a trading strategy regardless, because you would rather miss out on additional profits than lose your capital altogether. It's about identifying, and again, every trading strategy is different. Not everyone's going to have the same strategy regarding when you cash out, how much you invest, diversification, stop losses, etc. Everyone's different, and that's something that every investor, every trader needs to learn for themselves what they want to achieve, because everyone gets into investing for different reasons. And there are many ways to build trading strategies. It's not something you should do alone. It's something you should consult experts with or fellow mates who are in the investment world. Just ask them, how do you trade? What's your goal? And hopefully they have a game plan behind it. If they don't ask them. But it's about knowing how to safely invest. And if you don't know how to safely invest and how to set limits, you're going to miss out one way or the other, whether it's miss out on profits or lose a lot of capital along the way. So the fifth and final mistake that every relatively new crypto investor makes is attempting to time the market. So you hear all the time about FOMO, fear of missing out, waiting too long, emotional holding onto a dying coin. You hear about all these stories. They happen all the time. It's essentially just a natural part of crypto, the space these days. Now, what that means is, let's talk about XRP, for example. FOMO would have been last week, 2 weeks of this current date, where the project has risen 600, maybe 700% in the past month and a half. Now, people who bought in the past week or two, the price hasn't gone up right now. It's sort of staying stagnant at Australian $5, give or take. Now, the FOMO would have been someone waiting all that time to invest and thinking, oh my God, it's too late. And they invest there and nothing happens. It's because the FOMO in that case refers to they didn't believe it until it happened and they feared it, so they invested, but now the coin isn't going anywhere. in regards to that coin used to be 80 cents, 63 cents. So the FOMO in that case was they waited too long. On the flip side of that, you look at, let's say, Ethereum or Solana right now, where they haven't actually increased substantially, especially Ethereum. They've sort of stagnated where they are, especially Ethereum. In the recent, a couple of months ago, downforce of the market, lost a substantial amount of market capacity. And that FOMO kicked in hard, where people waited all that time to invest, attempting to time the next run. Then they invested because they thought it was about to happen, and the market fell, and they lost a lot of money. Now, they only lost it if they closed their position, of course, and it has gone back up. But a lot of people scared of that FOMO because they waited to time the market. And on an additional side of that, when it comes to smaller projects, let's say meme coins, for example, meme coins that express they have utility but they truly don't, people hold on to that token as it slowly falls in the market because they just have faith in this random dog face project meme coin. It's not a thing. And people hold on emotionally to dying coins when you just really shouldn't. And people do that for Bitcoin as well. There's a massive element of emotional holding onto Bitcoin, or regardless that Bitcoin has a lot more utility and substantial space in our financial world, yes, but people use emotion to leverage decision making. And it's not the right move to make when trading. So it's a big mistake people do is, waiting too long, trying to time the market. So my best tip for that is essentially don't time the market. Just put in $20 a week. Invest $20 of your wage, put it into the market, diversify it between what you want to purchase, Bitcoin, Ethereum, Solana, XRP, SUI, whatever you want it to make. Just put $20 in every single week, make it automatic if you want to, and just allow it to auto-invest. Or rather, if you really just want to have one lump sum, just put it in, let's say you got $5,000, just put in $1,000 into 5 different projects and just leave it. Don't try and time the market. If it falls, just leave it. If it rises, just leave it. If your goal is long-term investing, there's no point in trying to time the market because essentially in the crypto world, it's just impossible. It's the one place asset class that you just cannot time the market because it's too emotional. So, your best bet is just to invest when you are financially able to. Again, don't invest more than you can potentially financially lose. Be comfortable with your investment and be safe. So these are the top 5 mistakes that every new crypto investor makes, and I hope you found out as well how to avoid them. Again, leveraging, avoid that altogether. Airdrops, unless you absolutely guarantee 100% trust where they came from, avoid them altogether. Not disconnecting your decentralized wallet from third-party apps, always disconnect it. Not following a trading strategy, that's the number one thing when it comes to trading, regardless of what market you're in. You need to have a strategy. You can learn that through, consulting experts or just learning, sitting down, spending the time to truly identify what you're trying to achieve when investing. And the 5th one is attempting to time the market. Simply don't. Just invest when you're comfortable and only invest what you are financially comfortable to lose. As always, my name is Chris Shepley. Thank you for listening, and as always, trade smart.